Hi all, welcome to the video. This is Fundamentals in 5 minutes, where I take a topic relevant to startup founders and challenge myself to summarize it in 5 minutes or less. Today's video is all about venture capital, what it is, its purpose, and the pros and cons to consider for a founder. Venture capital is a big topic and I'm taking on quite a bit here. Can I get it all in under 5 minutes? You'll need to watch to the end to find out. Hey, Aidan Keneally here, professional founder coach and advisor to high growth startups, helping you, the startup founder, to be better than yesterday every day. Here in these videos, the focus is on you and your business. So if this is your first time seeing one of my videos, please feel free to subscribe for more content just like this. Now there's lots to cover in this video, so let's put 5 minutes on the clock. There it is, and let's get into it. First up, what is venture capital? Broadly speaking, venture capital is the preeminent financing tool for high-growth startups. Venture capital is a subset of private equity, and is typically managed by specialist firms known as venture capital firms. These firms specialize in raising and allocating capital into high-growth businesses. Venture capital is classed as a high-risk, high-reward type investment, and its job is not only to fund the growth of startups, but it's also designed to provide a high return for investors into the venture capital funds. And with that, we've summarized venture capital at a high level. Now it's on to the VC model. The venture capital model is pretty simple. VCs raise funds from investors with a mandate to allocate portions of each fund into a number of high growth startups. This results in a portfolio of high growth companies that the VC manages, all on behalf of their investors. The investors in such funds are usually institutional organizations looking for exposure into higher return investments. These investors will look different depending on the region the VC operates in. In simple terms, the organizations investing into VC funds in Silicon Valley are quite different to the ones investing into VC firms in Auckland. But in general, anyone investing into a VC fund is looking for high returns. VC firms are usually remunerated on a 2 and 20 fee structure. This means they earn a fee equal to 2% of the total funds under management per annum, and they stand to make 20% of any net capital gains achieved by the fund as a performance bonus. The theory of this structure is that the VC firm can cover their operating costs with the management fee, but also receive an upside if the investments they choose and manage grow well. And that's the VC model summed up. Now it's on to the purpose of venture capital. As mentioned before, venture capital is the preeminent financing tool for the high growth businesses. VC firms come in all shapes and sizes, with different investment theses on when and how much to invest into certain companies in certain circumstances. They can also specialize by industry or be vertical specific to further refine how they invest. From a founder's perspective, however, venture capital can broadly be categorized as the capital you seek to grow your business, not necessarily to develop your product or idea. If a company is in a product development or market validation phase, this is where angel investment is arguably more suited. As such, the purpose of venture capital is to fund sales and marketing growth within high growth startups. If a company has a product in market and is seeking capital to finance their sales and marketing growth, it will often seek venture capital to do so. And that wraps up the purpose of venture capital. Now on to how it works. In its simplest form, venture capital is like any other capital transaction. The company agrees to sell a portion of ownership in the company for a cash investment from a venture capital firm. Depending on the size of the deal, there will be a phase of due diligence prior to any offer of terms. This process is very much context dependent to the situation and the VC firm, and it's also outside of the scope of this video. But in general, there will always be some form of DD when dealing with a venture capital firm. Once DD is done, a term sheet is drawn up. A term sheet offers a high-level summary of the key points of the deal on offer. This includes the pre-money and post-money valuation, which will determine both the share price and the proportion of the company the investor will receive in exchange for their investment. If a company is raising capital from multiple investors, a company will often then nominate a lead investor who sets the terms for the raise. These terms are then presented to other investors who have the option to either accept or decline these terms. A lead investor with a single term sheet will make for a cleaner and more transparent transaction for all parties, and this is why they can be really valuable to get on board as you start your journey into sourcing venture capital funding. And so that wraps up how venture capital works. Now it's on to the pros and cons of venture capital. The risky nature of startups means more traditional forms of finance often don't fit with the needs of either the investor or the founder. And this is where venture capital provides the main benefit to startup founders. It's a specific financing tool for startups to help fund their growth. Furthermore, good VCs can offer other things such as their networks, expertise, and in some cases, a degree of validation and credibility for the startup. And in certain circumstances, when a large VC gets involved with a smaller business, this VC can often act as a bit of an investment partner over time. The ability to follow on from subsequent rounds can be invaluable to founders as it takes a lot of the stress and hassle out of trying to raise money. Again, this doesn't always happen, but it is something to be aware of, and if you can get an investor to support you through your growth, it is a really big advantage. There are, however, a few cons that founders do need to consider when taking on VC money. The first is that VCs can insist companies adopt less capital efficient growth strategies. Such strategies can set a company down a specific path that can result in the need for multiple capital rounds, which may not always be in the company's best interests. Second, because you're selling ownership in your company, you're tying yourself to a third party in a way that can be extremely hard to wind back should anything go wrong. Third and finally, when push comes to shove, it's also important to remember that the VC has the responsibility to its investors, not the companies they invest in. This fiduciary duty will influence how they behave as a shareholder and in the boardroom. And this may not always be a bad thing, but it's this fiduciary duty that can lead to decisions not always in the best interest of the founder. And with that, we're all done. Venture capital summarized in under 5 minutes. If you like this format and found this video of use, then hit the like button and feel free to share this with any other founder that may also find it of use. Finally, if you're watching this statement, thanks for sticking around. If you're a founder and you're struggling to find good advice for you or your business, then reach out for a chat. It's my business to help, and I do this by understanding you and your business. So if you want to understand how I can help you reach your business goals and smash them out of the park, then feel free to reach out with the link below. Until next time, my name is Aidan Keneally, professional founder coach and advisor to high growth startups, helping you, the startup founder, to be better than yesterday every day.